In 2025, the world is expected to suffer more than $100 billion in insured natural disaster losses. It will be the sixth year in a row that number crosses that line. Fires, floods, hurricanes, heat waves, each one breaking records, each one more expensive than the last. But here is the quieter shock. Your house does not need to burn down to lose its value. It does not need to flood. It does not even need to be damaged. It only needs to become uninsurable. Across parts of the United States, Australia, Southern Europe, and beyond, millions of homes are discovering a new kind of collapse. One that does not arrive with sirens or rubble, but with a letter in the mail. A non-renewal notice. A premium increase larger than a mortgage payment, or no offer at all. So how did we reach a point where an insurance policy, once an afterthought, can quietly freeze entire housing markets? Who benefits when risk is pushed down the chain? And what happens when the most important asset most people will ever own turns into a financial trap? This is the story of the uninsurable home and how climate risk is leaking from nature into markets, banks, and everyday life. For most of the 20th century, home insurance was boring. It was a stable product in a stable system. Disasters happened, but rarely at scale and rarely everywhere at once. Insurers spread risk geographically. Premiums rose slowly. Mortgage lenders required coverage, and homeowners complied. Insurance was not something you worried about. It was something you checked off. But that system depended on a hidden assumption, that the future would look broadly like the past. That assumption is now broken. To understand why, we need to step back and define what uninsurable really means. A home becomes uninsurable when private insurers decide that the expected losses are too high, too volatile, or too uncertain to price profitably. Sometimes they raise premiums, sometimes they add exclusions, and sometimes they simply walk away. When insurers retreat, governments often step in with last resort programs. These policies are usually more expensive, offer less coverage, and shift risk onto taxpayers. But even these backstops are under strain. The key point is this: insurance is not optional infrastructure. It is the foundation beneath the housing market. Without it, mortgages fail, transactions slow, prices soften, and entire regions begin to drift. This is not a climate story alone. It is a story about incentives, balance sheets, and how modern economies manage risk. And right now, risk is exploding. The first force driving this crisis is simple. Disasters are becoming more frequent, more intense, and more expensive. In the last decade, insured losses from natural catastrophes have surged. Wildfires now burn hotter and spread faster. Hurricanes carry more moisture and stall longer over cities. Floods hit regions once considered safe. Heat degrades materials, power grids, and water systems. What matters to insurers is not just that disasters are happening, but that correlations are rising. Events are no longer isolated. Fire seasons overlap, storms cluster, multiple claims hit balance sheets at once. This breaks the logic of traditional insurance. At the same time, rebuilding has become dramatically more expensive. Labor shortages, supply chain disruptions, and stricter building codes mean that each claim costs more than the last. Even a modest disaster now carries a large price tag. Then there is reinsurance, the insurance for insurers. Primary insurers offload part of their risk to global reinsurance markets. But as catastrophe losses rise, reinsurers raise prices or pull back capacity. When reinsurance gets expensive, insurers either pass costs to homeowners or reduce exposure. This is the pressure point where the system bends. Premiums rise faster than incomes. Deductibles climb. Coverage shrinks. And in high-risk regions, insurers stop writing new policies altogether. From the perspective of insurers, this is rational behavior. From the perspective of homeowners, it feels like abandonment. Nowhere is this tension more visible than in California. For years, California offered a preview of the future. Wildfires became larger, faster, and more destructive. Entire towns were wiped out in hours. Losses piled up. Insurers paid billions. Then something changed. Major insurance companies began freezing new policies or exiting the state. Others sharply limited coverage. Non-renewals surged, particularly in areas with high modeled wildfire risk. Homeowners who had paid premiums for decades suddenly found themselves scrambling for coverage. Many were forced into California's FAIR plan, the insurer of last resort. These policies cost more and cover less. Some do not fully protect against wildfire losses. The message was clear: risk had been repriced, and California is not unique. Florida faces similar dynamics from hurricanes and flooding, Australia from bushfires, parts of southern Europe from heat and flood. Each region has its own hazards, but the mechanism is the same. When insurers retreat, the cost of living rises. Not through rent or interest rates, but through risk transfer. This is where the crisis deepens. At some point, households do the math. Premiums jump by thousands of dollars a year, coverage shrinks, and wages do not keep up. Faced with rising costs, some homeowners make a dangerous decision. They go without insurance. In the United States alone, roughly 1 in 13 homeowners now has no home insurance at all. That represents millions of households and more than $1.5 trillion in exposed property value. This is not recklessness. It is survival. For many families, insurance has become the fastest growing housing expense, outpacing taxes, maintenance, and even mortgage payments. Dropping coverage feels like the only way to stay afloat. But this decision transfers catastrophic risk onto individuals who cannot absorb it. One fire, one flood, one storm. And a family's wealth is gone. What begins as a private coping strategy becomes a systemic threat, because uninsured losses do not disappear. They reappear as defaults, bankruptcies, and political pressure for bailouts. Risk does not vanish, it migrates. The next link in the chain is the mortgage market. Most lenders require homeowners insurance as a condition of the loan. If coverage lapses, banks can place insurance at extremely high cost or call the loan into default. As homes become harder to insure, mortgages become harder to originate. Buyers struggle to close deals. Sellers face shrinking demand. Appraisers discount risk. Liquidity dries up quietly. This is how climate risk enters the financial system. Not as a dramatic crash, but as a slow tightening. Fewer transactions, lower valuations, reduced credit availability. For banks, the concern is simple: collateral. If the underlying asset cannot be insured, its value becomes uncertain. If disasters destroy uninsured homes, recovery rates collapse. This forces lenders to reassess exposure. Over time, credit flows away from high-risk regions. And when credit leaves, people follow. This is where the housing crisis turns into a migration story. Families do not leave because they want to. They leave because they cannot insure, cannot refinance, cannot sell without taking losses. Insurance availability begins to shape where people can live. Entire regions risk becoming climate redlined. High-income households adapt first. They self-insure, relocate, or rebuild to higher standards. Lower-income households absorb the risk or get pushed out. The result is a new layer of inequality. Climate risk, filtered through insurance markets, reshapes cities and demographics. Safer areas grow more expensive. Riskier areas lose investment. Local tax bases erode. Public services weaken. This is not speculation. It is already happening. And it raises an uncomfortable question. Who should bear the cost of living in risky places? Different countries are answering that question in different ways. Some rely heavily on private insurance, allowing prices to rise and markets to retreat. Others socialize risk through national insurance pools or disaster funds. France, for example, operates a public-private system that spreads catastrophe risk across all policyholders. Japan invests heavily in disaster mitigation and strict building standards. New Zealand has experimented with government-backed insurance for seismic risk. Each model involves trade-offs. Socialized systems stabilize markets but reduce price signals. Market-based systems encourage adaptation but risk exclusion. No approach eliminates risk. They only redistribute it. What is clear is that ignoring the problem is no longer an option, because the scale of exposure is growing faster than current systems can handle. So what does a future with uninsurable homes look like? There are 3 broad paths. In the worst case, insurance continues to retreat, governments respond slowly, and households absorb losses. Housing markets fragment. Migration accelerates, inequality deepens. Disaster relief becomes more politicized and more expensive. In a middle scenario, governments expand last resort insurance programs without reducing underlying risk. Premiums stabilize, but public balance sheets weaken. Taxpayers quietly subsidize high-risk living. In the best case, societies confront risk upstream. That means investing in mitigation, fire-resistant construction, flood defenses, resilient infrastructure. It means updating zoning laws and discouraging rebuilding in the most dangerous locations. It means aligning insurance pricing with long-term adaptation, not short-term politics. And it means acknowledging a difficult truth. Some places will become harder to live in, not because people failed, but because the climate changed faster than systems adapted. This is not just a technical problem. It is a moral one. Housing has always been more than shelter. It is stability, identity, and security. When insurance disappears, those foundations crack. The uninsurable home forces societies to confront what they value, what they subsidize, and who they protect. It reveals the limits of markets and the costs of delay. Climate change is often framed as a future threat, but in insurance markets it is already priced in, quietly, relentlessly. The question now is not whether risk will rise. It is whether we will redesign systems to carry it, or leave individuals to face it alone. Because the next housing crisis may not begin with falling prices or rising rates. It may begin with a letter saying, coverage denied. And when that happens, the damage will already be done. If you want to understand where the economy is heading, do not just watch interest rates or inflation. Watch insurance. That is where the future is already arriving. And the choices made now by governments, markets, and communities will determine whether homes remain a source of stability or become the most fragile asset of all. What makes this crisis particularly dangerous is how invisible it is, until it suddenly isn't. Unlike a housing bubble, there are no bidding wars to signal excess. Unlike a banking panic, there are no queues outside branches. The uninsurable home crisis unfolds in spreadsheets, actuarial models, and renewal notices. It advances quietly, one zip code at a time. Yet beneath the surface, something fundamental is changing: the definition of risk itself. For decades, risk was something individuals managed with contracts. You bought insurance. The insurer pooled your risk with millions of others. The system worked because uncertainty was manageable and broadly shared. But climate change breaks that logic. It introduces deep uncertainty, not just about how big losses will be, but where and when they will occur. That is poison for insurance. When insurers cannot confidently price the future, they stop selling it. And when the future cannot be priced, markets freeze. This is why the uninsurable home is not just a housing problem. It is a capital allocation problem. Investors are already paying attention. Real estate developers quietly shift projects away from high-risk regions. Pension funds and REITs reassess long-term exposure to coastal and fire-prone areas. Municipal bond markets begin to price climate risk into borrowing costs for local governments. Risk migrates upward. Cities that rely heavily on property taxes face shrinking revenue bases just as they need to spend more on adaptation and disaster response. Local governments become trapped in a vicious cycle. Higher risk raises insurance costs, which lowers property values, which weakens public finances, which reduces resilience, which raises risk even further. This is how climate stress becomes macroeconomic drag. And yet, politically, the issue remains fragmented. Insurance is regulated at the state or national level. Housing policy is local. Climate policy is global. No single institution owns the problem, so the burden falls where coordination is weakest, on households. Consider the psychology of the homeowner facing a renewal notice with a 40, 60, or 100% premium increase. This is not an abstract policy debate. It is a monthly cash flow shock. It is a choice between insurance and groceries, between coverage and college savings. Over time, repeated shocks erode trust, not just in insurers, but in the social contract itself. People begin to feel that the system is no longer designed for a stable future, only for short-term survival. This is where the crisis becomes political. As insurance retreats, pressure mounts for government intervention. Subsidies expand, emergency relief becomes routine, but without reducing underlying risk, these measures merely delay the reckoning. The uncomfortable reality is that some losses are no longer insurable at any reasonable price. Pretending otherwise does not make societies safer. It only shifts costs forward. The uninsurable home forces a question modern economies have avoided for decades. How much risk are we willing to share? And how much are we willing to confront directly? The answer will shape not just housing markets, but migration patterns, public finances, and social cohesion in the decades ahead. Because when risk can no longer be outsourced, it must be governed. And governance, unlike insurance, cannot be canceled with a letter.